As the Australian economy begins to show signs of renewed optimism towards the global debt crisis, the Reserve Bank of Australia chose to leave interest rates at 3.5% today. On the phone with me now is Andrew Salter from ANZ. Andrew, was this decision from the RBA much of a surprise?
I think it was not a surprise to us and also to most in the market. I mean, I looked through consensus forecasts ahead of the release, and it looked like all but one economist was predicting no change in the cash rate. The RBA has been talking explicitly for a month or two now that they had put a material stimulus into the economy. In terms of central bank vernacular, that basically means that they've put in place some support, and they're now waiting to see exactly what effect that support is having on the economy.
The central bank has made 4 rate cuts since November, and although the RBA has now indicated that it wishes to let the market settle, do you anticipate further cuts in the short-term future?
Yeah, so I think that's right. They have put in place a moderately loose monetary policy, and they, in fact, in the statement today said that it's still too soon to actually see the effects of previous easing working its way through the economy. Obviously, monetary policy operates with a lag of 1.5 to 2 years, so it really depends on how the economy responds. For the record, ANZ is actually anticipating 2 further rate cuts in this cycle, 25 basis points both in October and November this year. Our expectation is that the global economy is going to weaken sufficiently to warrant that sort of response from the RBA.
Most commodity prices have declined, which has helped to reduce inflation. This is a bit of a double-edged sword though, really, because while lower inflation may stimulate consumer spending, which has received a boost via $2.1 billion in government carbon rebates and benefit checks paid out since May, but it's ultimately putting less money into the system. How are policymakers balancing this?
Well, I think in terms of the Australian economy, it's very much the latter. In economies like the United States, for example, cheaper commodity prices help to underpin economic growth. That's because commodity prices are such a strong input into production, and consumption is such a big part of the economy. In Australia, a lot of our export receipts are actually in commodities. I think around about 40% by value of our export basket last year was bulk commodities. And so it works in reverse in Australia. So lower commodity prices do in fact feed through to lower national income. And as we've touched on, that has some sort of impact on household expenditure, corporate profits, and domestic demand as well. It's a related reason why we've got a loose monetary policy in place. The central bank will pause now and step back and see how this loose monetary policy supports the economy. It's not an exact science. It's kind of unclear, but we do know which direction these income flows will be working on with a declining in terms of trade. So we've just got to watch this space and look towards indicators like domestic demand, retail sales to get a gauge of how the interplay of commodity prices and loose monetary policy is affecting the economy.
A slowdown in the Asian markets had been a cause for concern. However, the RBA Governor Glenn Stevens has stated that while China's growth had moderated, it did not appear to be slowing further, while US growth continued at a modest pace. According to Stevens, the most significant area of weakness continues to be Europe. How exposed to this crisis does Australia continue to be?
Arguably, we have seen a bit of a softening in consumer and business confidence in Australia resulting from the European crisis, and that has played out in indicators like retail sales, consumption, and business investment. So, I think we do continue to be a little bit exposed to it. But on the financial side, I think at the moment the assessment is that while there are financial linkages into Europe out of Australia, we do have a current account deficit. We rely on overseas savers to fund us. Those ties that we have financially are not coming under pressure, i.e. Australian banks and highly rated Australian corporates are still being granted access to funding in European capital markets. So, I don't think there's much of a consequence on the financial channel. I think it's mostly sentiment thus far.
The Aussie dollar looks to be trading higher against the majors following this news, hitting 5-month highs against the dollar. Is this a long-term trend or simply just reactionary? What are your forecasts on this pair?
So on the Aussie dollar, it has been well supported. Part of this is because of the support we've been getting from the interest rate differential, and that is entirely related to expectations for Reserve Bank policy. But it also is coming from another area, and that is the capital flows side of the balance payments. I mean, obviously that's a part of interest rates as well, but what we've been noticing is strong diversification trends out of some pretty core global bond markets into currencies like the Australian dollar. There has been a marked deterioration in the credit profile of a number of core government bond markets, particularly the United States, France, and a number of other Euro area peripheral nations. And you know, for a sovereign bond manager who's managing a portfolio to a mandate, and that mandate stipulates, you know, only highly rated assets are able to be held. There has been, you know, quite a strong push factor to redeploy those assets into highly rated investments like the Australian dollar. The Australian dollar obviously has reasonably deep capital markets and pretty transparent fiscal and monetary policies. And most importantly, it's got a stable credit outlook. So I think it's the diversification flows that are underpinning the Aussie dollar. I think we anticipate these flows to continue, and our forecasts reflect that. We expect the currency to hit $1.07 US cents by mid next year.
Andrew Salter there from ANZ. We'll be back shortly with more exclusive interviews. For now though, goodbye.